Rachel thought she was being smart. She'd spent 3 weeks researching cars, comparing models, reading reviews. She knew exactly what she wanted. A certified pre-owned BMW 3 Series. 3 years old, priced at £28,000. She walked into the dealership prepared, confident. 2 hours later, she walked out having signed papers for a £32,000 car with a monthly payment of £580 that she'd be paying for 6 years. She felt slightly confused about what just happened, but the salesman had been so friendly, so helpful. He'd assured her this was a great deal, that she was getting excellent value. It wasn't until 3 months later, when she actually read through the finance agreement at home, that the horror began to sink in. By the time she finished paying off that car, she would have spent £41,760 on a vehicle that would be worth maybe £8,000. She'd been trapped, and she hadn't even realized it was happening. Rachel's experience is playing out thousands of times, every single day, across Britain and America. People walk into dealerships thinking they're informed consumers, and they walk out having signed some of the most predatory financial agreements in modern commerce. Car financing has become a perfectly engineered system designed to extract maximum money from customers while making them feel like they're getting a deal. And the really terrifying part, most people never realize they've been trapped until it's far too late to escape. Today, we're going to walk through the 7 levels of car financing traps, from the obvious ones that catch beginners to the sophisticated psychological manipulations that fool even financially savvy people. By the end of this, you'll understand exactly how dealerships and finance companies are systematically extracting wealth from ordinary people, and more importantly, how to avoid becoming their next victim. Because right now, in 2025, car financing has evolved into something far more dangerous than most people realize. This isn't just about paying interest on a loan. This is about a multi-billion-pound industry that has perfected the art of financial manipulation, and you're the target. Level 1 is the most obvious trap, but it catches millions of people every year, focusing on monthly payment instead of total cost. This is the foundation of every car financing scam that follows. Dealerships are trained from day one to never, ever talk about the total price of the car. Instead, they ask you one simple question: what monthly payment are you comfortable with? The moment you answer that question, you've lost. Because once they know your monthly budget, they can structure any deal to fit that number while absolutely destroying you on the total cost. Here's how it works. You tell them you can afford £400 per month. Perfect, they say. They punch numbers into their computer, smile, and tell you they can make it work. What they don't tell you is that they've just extended your loan from 4 years to 6 years. That £24,000 car you're buying, over 6 years, at 8% interest, you're actually paying £28,800. But it fits your £400 monthly budget, so it feels affordable. Experian reported that the average car loan term in America is now 68 months, nearly 6 years. In the UK, 5- and 6-year terms have become standard. A decade ago, 3 years was normal. The industry has slowly normalized longer and longer terms because it lets them sell more expensive cars to people who can't actually afford them. The psychology here is brilliant and evil. £400 per month feels manageable. It's a number you can budget for. But £28,800 total sounds terrifying. So they never mention the total. They focus your attention entirely on that monthly number. And you walk out thinking you got a car you could afford. You didn't. You got a loan you could barely service. And they got to charge you an extra £4,800 in interest. This is level 1. And if you fall for this, every other trap becomes easier to execute on you. Level 2 is where things get more sophisticated. The trade-in manipulation. You have an old car, and you want to trade it in. Seems logical. The dealer looks at it, hums thoughtfully, and offers you £3,000. You think that sounds a bit low, but you're not sure, so you accept. Here's what actually happened. Your car was worth £5,000 on the open market. They lowballed you by £2,000. But they're not done. They then increase the price of the car you're buying by £2,000 to compensate. So on paper, it looks like you got £3,000 for your trade, and you're paying sticker price for the new car. In reality, you got £3,000 for a £5,000 car, and you're paying £2,000 over sticker for the new one. You've been robbed of £4,000, but the paperwork makes it invisible. The beauty of this trap is that it happens across 2 separate transactions that feel Unrelated. Eurobrain processes I got £3,000 for my old car and I'm paying £25,000 for this car as separate facts. You don't instinctively add them together to see the total picture. Dealers exploit this cognitive gap ruthlessly. Consumer Reports conducted a study and found that customers who trade in vehicles receive on average £2,400 less than private sale value in the UK and $3,100 less in America. That's not market efficiency. That's systematic exploitation. They rely on you not knowing what your car is actually worth and being too lazy or trusting to check. Every single day, thousands of people lose thousands of pounds at this stage alone. Level 3 is the interest rate markup, and this is where dealers make truly obscene money while you remain completely unaware. Here's how it works. You apply for financing through the dealership. They submit your application to their lending partners, banks, and finance companies. Those lenders come back with an approval. Let's say they approve you at 6% interest. The dealer is allowed to mark that up, typically by 2 to 3%, and keep the difference as profit. So they tell you, you've been approved at 8.5%. You think that sounds reasonable? And you sign. You will never find out that you actually qualified for 6%. That extra 2.5% on a £25,000 loan over 5 years costs you approximately £1,750 in additional interest. That £1,750 goes straight into the dealer's pocket as pure profit. The Financial Conduct Authority in the UK investigated this practice and found that dealers were marking up interest rates on 95% of finance deals, costing consumers an average of £1,100 per transaction. In 2021, they banned discretionary commission models for this exact reason, but dealers have found workarounds. In America, it's completely legal and utterly rampant. The Center for Responsible Lending estimated that interest rate markups cost American car buyers over $26 billion. Between 2011 and 2020, $26 billion. That's wealth extracted from working families purely through information asymmetry. You don't know what rate you actually qualified for, so you can't know you're being robbed. Level 4 is the extended warranty scam, which might be the most profitable trap for dealers. After you've agreed on the car and the financing, they send you to the finance office. A friendly person sits you down and starts talking about protection. This car is a big investment, they say. You want to protect yourself from unexpected repair costs. Then they tell you about their extended warranty. For just £35 per month added to your payment, you get complete coverage. Sounds reasonable, right? Here's the reality. That £35 per month over 5 years is £2,100. The average extended warranty is used for about £800 worth of repairs. You're paying £2,100 for £800 of value, and that's if you use it at all. Consumer Reports found that 55% of people who buy extended warranties never even file a claim. But it gets worse. That £2,100 warranty is being financed. You're paying interest on it. At 8% interest over 5 years, that £2,100 warranty actually costs you £2,340. You're paying £2,340 for an £800 benefit. Dealers make 50 to 70% profit margin on extended warranties. That's their highest margin product. The finance manager who sells you that warranty might personally make £300 to £500 commission on that single sale. This is why they push so hard. A dealership can make £500 selling you a car and £2,000 selling you warranties and aid. They make more money after you've agreed to buy than they do on the actual car sale. Level 5 is gap insurance and other financial products that sound protective but are massively overpriced. Gap insurance covers the difference between what you owe and what the car is worth if it gets totaled. This sounds valuable because cars depreciate faster than you pay them off, especially in the early years. The dealer offers you gap insurance for £600 to £800. What they don't tell you is that you can buy the exact same coverage from an independent insurer for £150 to £200. You're paying 4 times the market rate because you don't know you have options. They present it as part of the deal, something you buy from them, and you assume this is the price. It's not. They've marked it up 300% because they can. The same applies to paint protection, fabric protection, Veng etching, and a dozen other add-ins. They'll try to sell you in that finance office. Each costs them £50 to £100 to provide, and they charge you £300 to £600. These add-ons can add £2,000 to £4,000 to the total cost of your car. Almost all of it pure profit for the dealer. The National Automobile Dealers Association reported that the average dealership in America makes just 2.2% profit margin on new car sales, but 75% profit margin on finance and insurance products. They're not in the business of selling cars. They're in the business of selling financial products. And the car is just the bait that gets you into the finance office. Level 6 is the PCP balloon payment trap. And this is where people get locked into permanent debt cycles. Personal contract purchase sounds flexible, low monthly payments. And at the end, you can either pay a balloon payment to keep the car, return it, and walk away, or trade it in for a new one. Sounds perfect for people who like new cars but can't afford high payments. Here's the trap. Those low payments barely cover depreciation. After 3 years of payments, you have almost no equity. The balloon payment is enormous, usually 40 to 50% of the car's original price. Most people can't pay it, so they trade the car in for a new PCP deal. But the car has depreciated more than expected. There's no equity to roll into the new deal. So you start a new PCP with zero down, which means higher payments or a longer term. 3 years later, same situation. You're trapped in an endless cycle of car payments, never building equity, always owing money. The Finance and Leasing Association revealed that 89% of people who complete a PCP agreement immediately start another one. They're not customers, they're subscribers. The industry has turned car ownership into a permanent subscription service where you pay forever and owe nothing. And the beautiful part, from their perspective, is that you think you're choosing this. You think you like getting a new car every 3 years. You don't realize you're paying twice what the car is actually worth over its lifetime. Level 7 is the most insidious. The negative equity rollover. This is the final form of the trap. The end game where escape becomes nearly impossible. You're 3 years into a 6-year loan. The car is worth £12,000, but you still owe £16,000. You're underwater by £4,000. The car is starting to have problems, or you need something bigger, or you just hate the monthly payment. You go back to the dealer. They have a solution. They'll give you a new car. They'll pay off your old loan. Sounds like a rescue. It's actually quicksand. Here's what happens. They roll that £4,000 negative equity into your new loan. You're buying a £30,000 car, but they're financing £34,000. You're immediately underwater on the new car by £4,000. Plus the instant depreciation the moment you drive off. 3 years later, you're £8,000 underwater. Then £12,000. The debt compounds. People get trapped in cycles where they're paying £600 per month for cars, worth half what they owe. Auto debt in America has reached $1.6 trillion. In the UK, outstanding car finance exceeds £52 billion. The Money Advice Trust reported that car finance is now the second leading cause of personal debt problems in Britain, behind only mortgages. This isn't people buying too much car. This is people trapped in compound debt cycles they can't escape. The Federal Reserve Bank of New York, Pub, Lis, ED. Research showing that 17% of car loans in America are currently in negative equity. That's 1 in 6 people who owe more than their car is worth. The average negative equity position is $6,200. These people can't sell their cars without coming up with thousands in cash. They can't trade them in without rolling debt forward. They're locked in, making payments on depreciating assets that trap them deeper every month. This is level 7. And once you're here, financial recovery takes years. Now here's what makes all of this truly evil. These 7 traps work together, each one setting up the next. You fall for level 1 by focusing on monthly payment, which makes you vulnerable to level 2's trade-in manipulation. That makes you more likely to accept level 3's interest rate markup because you're already mentally committed to the deal. Once you're in the finance office, level 4 through 6 are presented as reasonable protections and options. And if you're already underwater from a previous deal, level 7 becomes inevitable. It's a system, perfectly designed to extract maximum money while giving you the illusion of choice and control. The automotive finance industry has perfected psychological manipulation techniques that rival casino design. They control the environment, the information flow, the time pressure, and your emotional state. They know that after you've spent 3 hours at the dealership, you're mentally exhausted and just want to finish. They know that if they can get you to say yes to the car, you'll say yes to the financing because you're already committed. They know that most people won't read the entire contract, and even if you do, The important numbers are buried in dense legal language. They know that you'll sign because you need a car and you believe you're getting a fair deal. Let me give you the numbers that dealerships don't want you to see. The average car buyer in the UK spends £2,800 more than necessary due to these financing traps. In America, it's $4,200. Multiply that by the 2 million new car sales annually in the UK and 14 million in America, and you're looking at £5.6 billion in Britain and $59 billion in the US, being extracted through financial manipulation every single year. This is one of the largest wealth transfers from working people to corporations happening in plain sight. And nobody talks about it because everyone thinks they got a decent deal. But here's the really disturbing part. It's getting worse. As car prices increase and people struggle to afford them, dealers are expanding these tactics. Loan terms are getting longer. ER loans are becoming common in America. Negative equity rollovers are larger. The add-ons in the finance office are more aggressive. The industry saw during COVID that customers would pay anything, Cigna needing accept any terms, just to get a car. They learned they could push further than they ever thought possible, and they're not going back. So how do you avoid these traps? First, never discuss monthly payment. Talk only in total price. If a dealer asks what monthly payment you want, say I'll figure out the payment once we agree on the total price. Second, know your trade-in value before you go. Check Trader. Check Kelly Blue Book. Get actual market data. Never accept the first offer. Third, get pre-approved for financing from your bank or credit union before you visit a dealer. Walk in with your own financing and only use dealer financing if they can beat your rate. Fourth, refuse all add-ins. In the finance office, every single one. If you want gap insurance, buy it independently. If you want an extended warranty, research it separately after you've left. Fifth, never roll negative equity into a new loan. If you're underwater, drive the current car until you've paid it down or save cash to cover the gap. Rolling it forward is financial suicide. Sixth, keep loan terms as short as possible, 3 years maximum. 4 if absolutely necessary. Anything longer means you're buying too much car. And seventh, be willing to walk away. The moment you commit emotionally to having that car today, you've lost all negotiating power. The dealer knows it, and they'll exploit it. Rachel, the woman from the beginning, eventually figured out what happened to her. 2 years into her 6-year loan, she'd paid £13,920, but still owed £20,800. Her car was worth £18,000. She was £2,800 underwater, and she'd be making payments for another 4 years. She did the math on what that car would actually cost her. £41,760 for a car that would be worth £8,000 when she finished paying. She'd be spending £33,760 on depreciation, interest, and fees. She could have bought the same car with a 3-year loan from her credit union and spent £29,200 total subbing herself. £12,560. That's a holiday every year for a decade. That's a house deposit. That's a child's university fund. Instead, it's going to a dealership that manipulated her through 7 levels of carefully engineered traps.